Hello everybody, the topic of this section is financial intermediaries. In this section, we will discuss non-financial intermediaries. Firstly, let's see what is financial intermediary. Financial intermediaries are firms whose primary business is to provide customers with financial products and services that cannot be obtained more efficiently by transacting directly in securities markets. Main types of intermediaries are banks, investment companies, and insurance companies. Their products include checking accounts, loans, mortgages, mutual funds, and a wide range of insurance contracts. Let's see the financial intermediaries one by one. The first one is bank. Today, banks are the largest in terms of assets and oldest of all financial intermediaries. The earliest banks appeared hundreds of years ago in the times of Renaissance Italy. Their main function was to serve as a mechanism for clearing and settling payments, thereby facilitating the trade in goods and services that had started to flourish in Italy at that time. Today, most banks are commercial banks who perform at least two functions: take deposits and make loans. There are many banks around the world. For example, in China, there are Bank of China, Industrial and Commercial Bank of China, which is ICBC in short, Agricultural Bank of China, and China Construction Bank, and so on. For other depository savings institutions, thrift institutions, or simply thrifts are the terms used to refer collectively to savings banks, savings and loan associations, and credit unions. In the United States, they compete with commercial banks in both their deposit and lending activities. U.S. thrifts specialize in making home mortgage and consumer loans. In other countries, there is a variety of special purpose savings institutions that are similar to the thrifts and credit unions in the United States. The next financial intermediary is insurance company. Insurance companies are intermediaries whose primary function is to allow households and businesses to shed specific risks by buying contracts called insurance policies that pay cash compensation if certain specified events occur. Insurance policies are assets of the households and businesses that buy them, and they are liabilities of the insurance companies that sell them. Payments made to insurance companies for the insurance they provided are called premiums. Generally, there are three types of insurances. In property and casualty insurance, its policies cover accidents, thefts, or fire. In health and disability insurance, its policies cover sickness or the inability to work. Policies that cover death are called life insurance. The next financial intermediary is investment bank. Investment banks are firms whose primary function is to help businesses, governments, and other entities raise funds to finance their activities by issuing securities. Investment banks also facilitate and sometimes initiate mergers of firms or acquisitions of one firm by another. Investment banks often underwrite the securities they distribute. Underwriting means insuring. In the case of securities, underwriting means committing to buy them at a guaranteed future price. The next one is venture capital firm. Venture capital firms are similar to investment banks, except their clients are startup firms rather than large corporations. Venture capital firms provide both advice in running their business and financing. And these two are the young firms with inexperienced managers often need. Venture capitalists invest their funds in new businesses and help the management team get the firm to the point at which it is ready to go public. That is, sell shares of stock to the investing public. Once that point is reached, the venture capital firm will typically sell its stake in the corporation and move on to the next new venture. Next, asset management firms, which are also called investment management firms, advise and often administer mutual funds, pension funds, and other asset pools for individuals, firms, and the government. They may be separate firms, or they may be a division within a firm, such as a trust company that is part of a bank, insurance company, or a brokerage firm. For the information services, many financial service firms provide information as a byproduct of their main activities, but there are firms that specialize in providing information. The oldest information service firms are rating agencies such as Moody's and Standard & Poor's for the securities business, and Best for the insurance industry. More recent growth sector is the firms or divisions within firms offering analysis of financial data, such as Bloomberg, Reuters, or performance statistics on mutual funds such as Lipper, Morningstar, and SCI. The next is pension and retirement fund. The function of a pension plan is to replace a person's pre-retirement earnings when combined with Social Security retirement benefits and private savings. A pension plan can be sponsored by an employer, a labor union, or an individual. Pension plans are classified into two types: defined contribution and defined benefit. In a defined contribution pension plan, each employee has an account into which the employer and yearly the employee make regular contributions. At retirement, the employee receives a benefit whose size depends on the accumulated value of the funds in the retirement account. In a defined benefit pension plan, the employee's pension benefit is determined by a formula that takes into account years of service to the employer and, in most cases, wages or salary. A typical benefit formula would be 1% of average retirement salary for each year of service. The last one, mutual fund. Mutual funds is a portfolio of stocks, bonds, or other assets purchased in the name of a group of investors and managed by a professional investment company or other financial institution. The mutual fund is the simplest example of financial intermediary, which pools the financial resources of many small savers and invests their money in securities. There are two types of mutual funds: open-end and closed-end. Open-end mutual funds stand ready to redeem or issue shares at their net asset value, NAV in short, which is the market value of all securities held divided by the number of shares outstanding. The number of shares outstanding of an open-end fund changes daily as investors buy new or redeem old shares. Closed-end mutual funds do not redeem or issue shares at NAV. Shares of closed funds are traded through brokers just like other common stocks, and their prices can differ from net asset value. In summary, in this section, we have discussed 9 types of financial intermediaries: banks, other depository saving institutions, insurance companies, investment banks, venture capital firms, asset management firms, information services, pension and retirement funds, and mutual funds. That's all about this section. Bye.